In a bid to cut carbon emissions by up to 20%, Airbus and CFM International are testing new open fan engine architecture on an Airbus A380, the world's largest passenger jet. This isn't just about making the world's largest passenger jet more efficient, but it's about a much larger goal. The aviation industry has made a bold pledge, a commitment to achieve net zero carbon emissions by the year 2050. This new open fan engine technology could be a significant step towards realizing that goal. It's not about minor tweaks or small incremental changes, but about a radical rethinking of how engines work. With this new technology, Airbus and CFM International are looking to understand engine and wing integration better, improve fuel efficiency, and ensure compatibility with sustainable aviation fuels. But the innovation doesn't stop there. Airbus is also planning to test an experimental hydrogen engine on an A380. The aim? To create a zero-emission airplane by the year 2035. This is a clear demonstration of Airbus's commitment to lead the charge in creating a more sustainable aviation industry. It's a challenging journey ahead, no doubt. There will be ground tests, flight test validation, and many hurdles to overcome. But the potential rewards are huge, not just for Airbus or the aviation industry, but for all of us who share this planet. This ambitious undertaking could revolutionize the aviation industry and bring us closer to a more sustainable future. Analysts are warning of market uncertainty due to hawkish Fed policy and historic inflation. In recent times, stocks, once a robust hedge against inflation, are losing their appeal. This turn of events can be attributed to weakening corporate earnings and soaring inflation rates. With these factors in play, the S&P 500, an index that many investors keep a close eye on, could experience a fall of up to 17%. Economist Mohamed El-Arian has voiced concerns about impending economic turmoil and even a possible recession. This prediction is based on the policy response to high inflation. In the face of these economic trends, U.S. futures are edging higher as the Fed prepares to hike rates. Meanwhile, the 10-year Treasury yield has surpassed 3%, adding another layer of complexity to the financial landscape. While these developments unfold, investors are receiving advice from various quarters. Savita Subramanian from Bank of America, for instance, is advising investors to play defense as the risks of a recession rise. This is a strategy that involves choosing stocks with stable earnings and low debt levels, among other things. In the midst of these market dynamics, there's an air of uncertainty. The tug-of-war between bullish and bearish market sentiments, the fluctuating yield rates, and the looming shadow of inflation all contribute to this sense of unpredictability. As the market landscape becomes increasingly uncertain, investors are urged to tread carefully. It's a time for cautious optimism, for staying informed, and for making decisions that are not just profitable in the short term, but sustainable in the long run. After all, the financial market is a marathon, not a sprint. A trader error at Citi caused a flash crash in Swedish stocks, while Tata Steel decided to stop importing Russian coal. In the fast-paced world of finance, every move can have ripple effects. One such ripple was caused by a trader error at Citi, leading to what's known as a flash crash in Swedish stocks. A flash crash, for those unfamiliar with the term, is a sudden, dramatic, and often short-lived drop in value. This isn't just a hiccup for investors, it's a heart-stopping plunge that can shake confidence in the market. Let's delve into what happened. At Citi, a trader error led to this flash crash, a stark reminder that even in an era of algorithmic trading, human error can still trigger market mayhem. The implications for Citi and its traders are significant. Beyond the financial loss, which can be substantial, there's the reputation damage. Trust is a precious commodity in finance, and incidents like this can erode that trust. It's a wake-up call for the industry about the importance of robust systems and checks to prevent such errors. Now, let's shift our focus to Tata Steel and Russian coal. In a move that underscores the far-reaching implications of international policies, Tata Steel has decided to stop importing Russian coal. This decision comes in the wake of uncertainties created by Western sanctions on Russia. Tata Steel's move is a clear example of how geopolitics and business are intertwined. The decision to cease importing Russian coal is not just about sourcing raw materials, it's about navigating a complex global landscape where policies and sanctions can impact supply chains. It's also a reminder of the need for businesses to be agile, to be able to adapt swiftly to shifting circumstances. These instances highlight the global impact of individual actions and international policies on the market. Wall Street is divided on the future of stocks, with Goldman Sachs and Morgan Stanley predicting more downside, while JP Morgan remains bullish. This division reflects the current climate of uncertainty and speculation in the stock market. Goldman Sachs, one of the leading global investment banking, securities, and investment management firms, has lowered their year-end S&P 500 price target. This move comes in response to sluggish growth and high interest rates that are impacting the markets. The lowered target is a sobering prediction, indicating that the firm believes there are challenging times ahead for investors. In a similar vein, Morgan Stanley, another major player on Wall Street, is predicting negative earnings revisions and a stock market decline. This forecast suggests that the firm expects companies to lower their earnings estimates, a move that often leads to a drop in stock prices. Morgan Stanley's prediction adds to the growing concerns about the future of the stock market and the potential for a downturn, but the outlook is not uniformly gloomy. JP Morgan's Marko Kolanovic remains bullish, offering a contrasting perspective to those of Goldman Sachs and Morgan Stanley. Kolanovic believes that stocks will rebound as the market has priced in an excessive risk of recession. This optimistic prediction suggests that the current market conditions may present buying opportunities for investors who share Kolonovic's belief. In this complex and rapidly changing landscape, these differing predictions highlight the inherent uncertainty of the stock market. Each prediction is informed by extensive research and analysis, yet they point to different outcomes. The stock market, after all, is influenced by a multitude of factors, many of which are unpredictable or beyond our control. With differing predictions for the stock market, only time will reveal the accuracy of these forecasts. As we move forward, investors and market watchers alike will be keenly observing the market trends, ready to adjust their strategies based on the unfolding realities. You've seen script. U.S. futures and cryptocurrencies, including Bitcoin, rose early Tuesday, while Big Short investor Michael Burry revealed his bearish bet against Apple stock. In the world of finance, unpredictability is the only certainty. Early Tuesday, U.S. futures and cryptocurrencies, including Bitcoin, experienced a surge. This uptick in value is a welcome change, particularly for cryptocurrencies, which have been subject to significant volatility in recent times. As digital currencies continue to carve out their place in the financial landscape, these fluctuations are to be expected, yet they still attract considerable attention from investors worldwide. Speaking of investors, Michael Burry made headlines with his bearish bet against Apple stock. Known as the Big Short investor, Burry's financial moves are closely watched by many in the industry. His decision to bet against one of the biggest tech companies in the world is a bold move, and it will be intriguing to see how it plays out. In another noteworthy move, Ray Dalio's Bridgewater Fund sold its Tesla stake and invested in GameStop and AMC. This decision marks a significant shift in investment strategy, moving away from a tech titan to companies that have been at the heart of the so-called meme stock phenomenon. It's a move that highlights the unpredictable nature of the stock market and the ever-changing strategies of investors. The financial market is always in flux, with tech stocks and cryptocurrencies often at the forefront of these changes. These sectors are known for their volatility, but they also offer the potential for significant returns. As the market continues to evolve, it's crucial for investors to stay informed and be prepared to adapt their strategies accordingly. As cryptocurrencies and tech stocks continue to make headlines, investors are keeping a keen eye on these volatile markets.